The White House panics. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the Biden administration is set to announce the unexpected on Monday, and this is something the markets are not expecting to happen at all. And if you understand what the Biden administration desperately needs, they need inflation to come down, they need the economy to grow, and they need the Fed to cut rates, and they need this now, especially as they head into the November elections, to give the president a chance at a second term. The problem is the economy isn't doing these things, so when it doesn't, well, how do you incentivize it? Well, maybe you do some things to nudge it in the path that you want. So let's over to Bloomberg, where he picked today's story up, and I want to give you a little background as to what the Biden administration is planning to announce on Monday as we look at inflation as it's overshadowing U.S. economic resilience, and this is hurting Biden's chance at re-election in a big way. And if we look at the recent GDP data, well, you see it decelerating. And what has Washington done? How have these political elites spun this? They simply said, well, this is indeed the soft landing. We're slowing down, but trend growth is still okay. What they're hoping is it doesn't get worse in the next quarter. And we know the probabilities that that's going to happen are increasing every day. So they need something to turn the growth engine of the economy around, and much sooner than later. And this is a lose-lose for the president. And this from an economist at Bloomberg is he doesn't get to realize the benefit of hot growth because it's coming at the cost of high inflation and interest rates. And this is absolutely true. This economic resilience is borderline problem for Biden. And this report comes at a perilous time for the president's campaign. Americans were already sour on economic conditions, and well, for good reasons. And research suggests that voters begin to make up their minds about the direction of the economy about 6 months before an election, or, as I suggested, right now. And that's why they need something to turn the economy around, because when we look at GDP against a real GDP, now real means inflation adjusted, that's shown in red, and what you can see is there are times due to high inflation that you get high growth of the economy. And that's exactly what we're seeing now. The challenge is most Americans, because we've talked about how their total compensation growth is slowing, that they're not participating in this growth. They're actually getting behind, and that is a huge issue. This is really what's facing the administration and why they're looking at making such a desperate move here. As we look here to a poll of voters in 7 battleground states this month showed that more than half expect the economy to be worse by the end of the year. And at least half of voters say they expect inflation rate and borrowing costs to rise even higher than they are now. And you think about this for consumers that are seeing their wage growth slow, they're seeing their hours worked get cut. The last thing they need is more inflation and higher interest rates. They need the opposite to happen. The problem is the Fed is on ice right now. The economy not moving in a direction, and inflation isn't moving in a direction to get the Fed to cut. But maybe, just maybe, you can do something to make that change happen. And as a result, the Biden campaign has largely retired the term Bidenomics that was used to define the economic case for re-election, and is emphasizing issues like abortion rights and protecting democracy, hoping that voters feel aligned with that. But something that you should be aligned with is how to protect and invest your money, whether you're a trader or maybe you're just trying to watch your out for your 401k. I want to show you, this is a big trade that we put out to all our subscribers. And this isn't just something we put on a report. We did videos, we showed them, we followed up with them. Look at this. Back in March, if you would have followed our CTA report, you'd be up 13% on this trade. If you're on Momentum Time Pro, it was flagged twice. First time, now it's up almost 12%. The other one, over 10.5%. And this is at a time when the market was going down, and we were showing our subscribers how to hedge their risk, how to control their money, make more with it. And the question now you might be wondering, is this an opportunity to get in? Well, today I put out a video to both of our subscribers giving them some very important information along with updates on trades, because over the last 2 days we put out a whole bunch of trades. You're missing out on what you can do with your 401ks, your IRAs, or even your trading account. How do you jump into this? Well, there are links in the description below for a 30-day free trial. You want to trade with machines? We'll do that. We'll show you how to be an expert, how to get ahead of the machines, because we do what they don't. We run a historical overlay. We show you when it's time to get in before they do and time to get out before they are, and we back it up with videos. We have, if you're a technical trader, you find yourself getting in late and then out early. Well, we've got Momentum Timer Pro. What that does, it takes all those technical signals that you chase down every day, adds a proprietary overlay. We throw out the signals to you and we give you a video. Again, links in the description below. You don't have to be an expert. We'll teach you how to make more money in the markets. And this is an issue because we look at consumers and they desperately need to make more money right now. And why is that? Because their total compensation growth is slowing. They're getting concerned about a market turn down, and we can help you protect that, because what's happening right now, and this is the issue the Biden administration doesn't understand, is the consumer price index right now is below total compensation. Now, this is great news. The issue is that consumers think inflation's going higher. They think interest rates are going higher, and they're just at a point where they're saying, hey, you know what? We can see now that we've getting ahead. Now, we've got a lot of debt from, of course, the past couple years that we're dealing with, but they're finally thinking that, and now all of a sudden they're starting to realize that maybe we're not going to be ahead at all, and this is not a good sign for the current administration or the economy, as it's also getting harder for Biden to avoid getting blamed for rising prices, as peak inflation was clearly driven by the supply side snarls triggered by the coronavirus pandemic. Those problems have largely been resolved. What remains appears to be linked to demand, driven in part by deficit spending. So we talk about demand, and this is a huge issue, because what is the Fed's responses? Well, to get inflation down, we have to curtail demand. We need to reduce demand, and we need to do it in such a way it doesn't throw the economy into recession. And if you think about how backwards policy that is, if you have too much demand, then the simple answer is get more supply. Why would you want to pull back demand? Because you risk bringing the economy down into a recession. And so that's the issue here, is they're trying to throttle back the economy. They're trying to bring inflation down, and it's starting to see, as we know, the early signs of recession. Again, if you're an incumbent president, we know a recession is a 0% chance of getting reelected. And that's why, of course, we now turn to Janet Yellen, because she is the one behind the big move. But let's hear what she had to say first, as she notes that U.S. can bring down inflation without hurting jobs. And that would be impressive, because if we look at prior cycles, the fastest way to bring inflation down is to drive the unemployment rate up. And it's a very simple reason. People on unemployment spend less because they have less income, and that makes inflation go away really quickly. But she's saying, look, I don't see any reason why unemployment needs to rise to bring inflation down. Well, that is just one way to do it. She said there's no evidence that the labor market is so hot that wage pressures are a source of inflation. She said, assessing that the jobs data are in line with a continuing downward move in inflation, a case that we've made. But what if you can't get inflation down? Then you need to turn the growth engine up where more people feel they're participating. At the same time, you've got to get the Fed to cut. That's their move here. And we'll show you what exactly the administration is planning, because when you talk about recessions and you talk about inflation, well, again, you look at continued claims, and we go back to the last 3 recessions, and what happens? Continued unemployment claims rise, inflation comes down. Continued claims rise, inflation comes down. And what is this on the back of? And again, global financial crisis, inflation rallied, and then, well, it turned into deflation. And what happened? The Fed throttled demand back, and that's the issue they don't understand. They pull back the reins of the economy, they think nothing bad happens, and then bad things do indeed happen. This time she's saying maybe we can get it right, as the biggest component of the increases in the consumer price index have been housing costs, she notes. And I have no doubt that the contribution from this component will be falling over the coming year. Well, that is indeed true. Rents have stabilized, in some cases fallen, in a shift that will be incorporated into shelter component of the CPI over time. And again, this is one of the biggest lagging components of an index that is already a lagging issue. And so now we see the setup here. They need inflation to come down, but the problem is their reports won't show it. They need the economy to grow because it's slowing down. That's not a good sign. And they need to get the Fed to cut. So if you were in the Biden administration, what would you do? Well, you do what they're potentially about to announce on Monday. And this is how Janet Yellen will unleash another market melt-up next Monday. It won't just be for the market. It'll be a number of other things, potentially even getting the Fed to cut. And long before most heard of the Treasury General Account or the quarterly refunding statement, Zero Hedge was the first to point out and correctly predict how the Treasury's near-then-record $1.1 trillion cash balance would serve as a liquidity tsunami as it was rapidly drawn down, boosting asset prices in parallel with the Fed's still massive QE. Now remember, we're not doing QE right now, and that was an unprecedented tidal wave of money, which is a catalyst sending Bitcoin and equity prices higher. But what is Ms. Yellen potentially going to do? Well, their next Treasury QRA announcement, this is going to be on Monday, or potentially somewhere around Wednesday, but it's expected to be on Monday. Either April 29th and May 1st, is absolutely possible that due to tax receipts coming in so strong, this with wage growth and huge capital gains over the last year, that Yellen could again surprise the markets. This would be the unexpected with another low financing estimate thanks to said TGA bill. Now the TGA, if you're not familiar with it, that's effectively the government savings account. When they raise taxes, it goes into the Treasury General Account, and then it gets spent out from there. When they borrow money, it goes there too, which she would then allow her ability to communicate a lower expected total bond issuance for the next 3-month period ahead versus the street's prior estimates of financing needs. Again, the market is not expecting it. That's a key point, which could help drive a bond short squeeze again and boost risk sentiment. Admittedly, nowhere close to the magnitudes of the prior surprises. And why would she want to drive interest rates down? Well, I'll show you here in a moment, but there's a reason that she could get rates to drop in a meaningful way, and that's because so many people are short the bond market or even don't own it, so they're indirectly short. And here you can see aggregate Treasury futures positioning. The market isn't at their ever shortest position, but they're deeply short the bond market. And if you can do something that could trigger a big short squeeze, well, that would send rates coming crashing down. And that would be meaningful in a big way because it sends a message to the Fed. Now, granted, they're meeting next week and unlikely to make a change based on anything that could happen Monday. But here we see rate strategist John Combs, this from Nomura, published a view about the forward impacts of ongoing QRA surprise and issuance twist. He says if financing needs are lower, then bill supply, that's Treasury bills, should be lower given the likely static coupon auction sizes. In the medium term, I think the Treasury may consider leaning more on bills within its debt composition, especially if the Fed plans to keep a larger portion of SOMA in bills, and this would potentially then keep the distribution heavy in bills to the benefit of duration and basically maintaining a twist where they reduce the issuance of notes and bonds and bias towards bills. That would then signal a massive short squeeze to the market in a surprise move. Now, why does that matter to the Fed? Well, it's simple. Fed doesn't follow inflation. They say they do. They say they follow the jobs market. They don't really follow that either. They follow the bond market here. And if you see 2-year Treasury yields in blue against the federal funds rate, you want to talk about a correlation, run the funds rate against inflation as we've done, or the jobs market. Nothing is as good as 2-year Treasury yields. And if you see Treasury yields start to come down because, of course, Janet Yellen gets the market into a big short squeeze, well, now all of a sudden you start to put the Fed in a position where they have to initiate a rate cut well ahead of what the market's expecting. So this is a prime move. Then you have that flood of money hitting the economy. And what does that do? Well, it juices consumption. So you get 2 of the 3 things you want. But can you get a third of inflation coming down? Well, maybe. As Fed's preferred core inflation gauge rose at the brisk pace in March. So here today we got the personal consumption's expenditure, and what do we see? That it indeed came in higher than expected, but that's not a real surprise because we know the PCE does indeed follow the consumer price index, so that's not a big issue here. What we want to do is look at, of course, the underlying parts of it, as demand for workers here is still healthy, supporting wage growth. Well, we'll see how that holds up when we get the next payroll report. Overall incomes decreased 0.5% as wages and salaries rose 0.7 for the second month, that being the strongest back-to-back gain since the start of last year. But one of the challenges here is we're seeing the personal savings rate draw down, which is something that wasn't covered in the article. So what we can note is when we look at total compensation, this is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. What we're seeing is a big drawdown here and slowdown in total compensation growth. Now, even though the chart suggests, as I showed you earlier, the total compensation is staying ahead of the consumer price index, many people aren't actually feeling that because of higher interest rates and debt service costs. So what we've noted, and this is partially supporting inflation, is that consumers have been drawing down their savings, and this is dangerous because when it gets too low, well, then all of a sudden there is a change in sentiment among consumers. They cut back their spending to raise their savings account, and that has a big impact on inflation, as you can see in this chart. When you see periods where the personal savings rate is trending higher, well, eventually it means the consumer price index, shown in red, is headed down. You see that happen right now, that the reason we're seeing some probably transitory moves in the consumer price index has literally everything to do with the fact that savings rate is being drawn down as consumers try to keep pace with rising costs. But again, is it possible that inflation could come down? Well, one move is as consumers could start getting down into the red of their savings and decide to start saving. Another one, well, is China. As China is pivotal for U.S. inflation's path here from Bloomberg. And what they note in their article is inflation is indeed more stubborn than expected. And well, if we could see some more deflationary pulses out of China, that would help in a big way, because what they have noted, something we've made as a claim and showed you on the show more times than we can count, is that the U.S. CPI is highly correlated to the China PPI, China being a big driver of global inflation pressures. In fact, if the country had a stronger recovery, it is likely that the U.S. and other countries would be contending with larger inflation problem than they currently have. And the evidence of that is very clear in this next chart. As we can see, the consumer price index in red against the producer price index, this total economic activities from China, which is in deflation. Remember, it's on here on the right side. So we see China is exporting deflation. And even though there is a bit of a boost here in the consumer price index, as we see U.S. consumers draw down their savings rate, well, likely due to the fact that energy prices are higher and they're struggling to keep up with their wages. Well, what it tells us is that once consumers start to switch and start to save, China's deflationary pulse, that'll bring inflation down. And perhaps if Janet Yellen could trigger a massive short squeeze, that'll get the Fed perhaps into cutting mode in the months to come. And with all the flood of money that could be pushed out in the economy, you get the growth that you need. Will it happen fast enough for President Biden to get that coveted second term? Well, we'll see. You can weigh your view in the comments below, and now you can see why they're panicking. And either it's on Monday or maybe by Wednesday, the Treasury is expected to announce the unexpected. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.